Good evening, everyone, and welcome to the webinar. My name is Sara, and I have over a decade of experience in the financial markets as a prop trader and as an educator with a main focus on derivatives, currencies, and commodities. I'm licensed from FINRA in the US and from ESCA UAE as an investment manager and as a financial analyst. I've been running professional trading courses since the last 10 years, working with people from all different backgrounds and fields, focusing on building a system of sustained profitability, focusing on risk management, trading psychology, as well as high probability trade setups. I've also been involved in financial investigative journalism. So welcome to Amana. We have a track record of 15 years and over 100,000 traders worldwide. We offer over 5,500 financial instruments across multiple asset classes, which include regional and international stocks, currencies, commodities, and indices. So if you have any questions, feel free to write them in the Q&A section below. Please don't use the chat. There might be some issue with my internet connection. So if you cannot hear me properly, please also mention that in the Q&A so that I know. So if you want to reach out to us, you can email us at support@amana.app, or you can call us directly, you can email us, you can reach out to your relationship manager, or you can contact our live support through the app, through the Amana app. Can anybody please confirm to me if you guys can hear me properly? If the connectivity is fine? Okay, fine. Thank you. I'll prefer if you can write in the Q&A section instead of the chat, because I have that opened in front of me. So today's topic is advanced price action trading. If you have attended the webinar that I gave on Tuesday, I talked about what is price action trading and why it's important to understand that price is the main factor that we must rely on in order to predict the markets. And today I'm going to take this topic further. I'm going to delve into very specific price action signals which help you determine exact entry or exit points in the market. Because as traders, obviously that is what we're looking for. We just don't want to know where the price is going. We don't want to know why the price is moving, but we want to know exactly where the price is headed so that we can profit from it. So there is another topic that I will cover if we have enough time, which is false breakouts. But first, I would be covering different high probability price action setups. And if we have time, then I will move into understanding what are false breakouts, how we can identify them, and how we can, as traders, benefit from them. So I think most of you know that price action trading is the discipline of making all of your trading decisions from one leading indicator, which is price, by looking at the price charts. In other words, we use the raw price alone as the biggest and the most clear indicator of trends of support and resistances and entry points. This means that we are not relying heavily on anything else, which is the news or the geopolitical situation, or even things like inbuilt technical indicators and tools that you see are available on the trading platforms. So as you know, that the financial markets generate data every second, every millisecond about the movement of prices. All this data gets captured on the price chart. Now, these prices are reflecting the actions and the beliefs of each and every participant, whether it is a human, it's a computer, it's an algorithm, it's institutions, whether it's the government, whether it's speculators like me and you. So the equilibrium, of all of those actions taken by all of these participants is the price. And this is what you must understand. While we have economic data and global news and events which are catalysts which move the price, it's very difficult to, first of all, know and analyze all those variables in detail. And also, there might not actually be a need to do that, simply because all economic data and world news that cause these movements will ultimately be reflected in the equilibrium prices. So the equilibrium price is what? It is the intersection of the demand and supply of a certain market. The demand and supply is happening due to so many different variables. Wherever they intersect is the actual live price that you see. So trading using different price patterns is called price action trading, and there are many different strategies and there are many different ways to do that. Now, there are a lot of indicators as well as you know on which are inbuilt into the trading platform, which, for example, you can go and you can search for so many indicators here, and I'm sure some of you might be using them as well. But the thing to understand again is that these indicators themselves are derived from the prices. So a mathematical function is applied to the prices, a certain mathematical function, and from there, these indicators are derived. So again, the main ingredient in these indicators is also price. And they are like ultimately mathematical calculations derived from the price. So these indicators would then they don't have the ability to predict the price. They are simply a translation or an interpretation of the price. So you have to understand the difference between like a certain depiction or translation versus prediction. So they can definitely translate the price in a certain way, let's suppose by smoothing the price, by making it easier to understand the historical price, but then again they lack that predictive ability. So also when we come to volume, a lot of people use volume indicators. I'm not a fan of using volume indicators in big markets, which are trillion-dollar markets, because the volume is deep everywhere and it tends to get normalized across sessions and across time. So again, in that sense, when you are trading such markets, big markets, what actually matters is the price, because it's the price which will then move, which will create the real buying or selling pressure. That's where the buying or selling pressure will be created from. So again, in a way, it's price which is leading in these markets, not volumes. Now let me move on to the next important concept, which is again the higher time frames. So before I go into the detail of price action setups, I want to just reiterate that we spoke about this earlier, that lower time frames such as intraday charts, such as the 15-minute or the 30-minute or whatever, the 5-minute, they are highly influenced by short-term volatility and market noise. So these movements are often driven by temporary liquidity flows and do not accurately reflect the broader macroeconomic environment. So higher time frames such as the daily, weekly, or monthly provide a much clearer picture of the market, and they actually reflect institutional positioning, and they capture the underlying trend driven by the macroeconomic forces or the geopolitical events. So they reflect actual fundamentals. So for long-term trend analysis, and actually to be able to understand the overall, direction of prices in a market, you have to be looking at the higher time frames. And because that's where the trends develop, and then they tend to hold over time, which could be months to years. Okay, so it is from the higher time frames that you should actually be developing your directional bias. And yes, with time, if you want to trade on the lower time frames, you can actually do that. A lot of people are trading successfully on the 4 hourly or even on the 1 hour hourly time frames, but then their perspective is coming from the higher time frame. So what they do is they are moving from the weekly to the daily, after having an understanding of the trend and the support and resistances which are on the higher time frames, and then using that information to help them trade on the lower time frames. which will give them much better and more predictable trading results, which will give them better stop loss placements, which will give them better entries and exits. So I'm not completely discounting. I'm not saying you should never go on the H4, H1 or lower time frames, but what I'm seeing is that they first, they must be read in conjunction with the higher time frame. So again, yes, you can change the time frames over here. If you go here, you can switch to the H4 or the 1 hourly, etc. So coming back to the most important point, that the daily time frame reflects the entire one candlestick on the daily time frame reflects all the market session. So whether from the morning till the evening, from the Australian to the Japanese to the London session to the New York session, one candlestick is reflecting all this information inside it. So as a result, the daily close, which is aligned with the American markets close, reflects actual institutional settlement. And that then is a good predictor of the future movement, of tomorrow's movement. So again, remember that closing prices are the most important prices of the day. And with respect to that, closing prices again on the lower time frames are not aligned with a certain session or with a certain event or with a certain variable. So they might not be able to give you that kind of predictive ability, that kind of predictive ability. So I'm going to now go to some of the core candlestick or price action patterns, which when found in confluence with other factors on the price chart. And by price chart, I mean the daily time frame, because I'm using the daily as my major frame of reference. So please remember, when I'm talking about the price charts, I'm just talking about the daily, unless I mention it otherwise. Now, we have a candle pattern which is something like this that you can see on the screen. So this is a candle which has a long downward tail. Now, before I go into this, I must tell you that, there are so many different types of candles. As you know, a candle will reflect the open, high, low, and close of the day, okay? But not all candlesticks are important. Like every candlestick carries a message, and you need to understand how to read the message, but not every message is important. Just like you have a lot of people messaging you on, WhatsApp, and you tend to ignore a lot of messages and you tend to respond only to the important ones. In the same way, you definitely need to know which candlestick is reflecting what. It's a change of sentiment, it's a continuation, it's a lack of interest, it's low participation, it's thin volume, it's indecision, it's a pause, it's a consolidation, it's a change of momentum, whatever, right? But you should know that you should not be reacting or opening a trade because you just, to all of them, right? So the key is to distinguish between the high probability setups and the background noise, right? Now let's move back to this pattern. So if I see a candlestick which has a long downward tail, what does that mean? Now, such candlesticks are quite bullish in nature, which means that they are reflecting upward price pressure, right? Why are they reflecting upward price pressure, or why do they mean that the buyers are stronger than the sellers, or the buyers have become stronger than the sellers in the course of this day? Remember, this candlestick is representing the trading activity of the entire day. So what is happening is that, let's suppose prices open at this level. During the day, the sellers come in for whatever reason, and they start to drop the prices down, right? And as an intraday trader, what it might seem to you that prices are going down and the trend is downward. But then what happens is, somewhere during the middle or towards the end of the day, even towards the end of the American session, maybe it could be even the last 2 hours of the American market, prices are reversed as buyers step in and push the prices all the way up and reverse all the losses of the day. So what this actually means is prices have rejected lower levels. Why I say they have rejected lower levels is because they failed to close lower. They failed to close at lower levels, which means that prices dropped, but they were in a phase of just testing if they could go lower. However, they failed because the buyers came in. They did not accept, people did not accept prices going down. They came and they pushed them all the way back up, leaving behind a tail. What that implies is prices have rejected lower levels. They do not want to be closed lower, which means, in other words, they are building upward pressure and they want to break upwards. So such a candlestick with a lower wick is simply giving us a clue that buyers are back in the market and prices have failed to close low, which means that tomorrow or in the future, they can break upwards. Similarly, this is the opposite interpretation. This means that sellers have become dominant towards the end of the day. So the conclusion of the day is that sellers came in and they pushed the prices all the way down and they reversed the day's gains. So let me go over this again. First of all, the buyers push the prices up. So during the day, you might be thinking, okay, maybe there's a major breakout, maybe we will end up much higher. And then what you see is towards the middle or end of the day, prices fell all the way down. They reversed all the gains of the day. Why? Because prices failed to close higher. People did not accept closing prices at higher levels due to whatever reason. Maybe there was, institutions due to whatever reason uh, did not wish to close higher and they closed lower, or it could be any other reason. But we're not interested in the reason. What we're interested is where are prices going tomorrow. And this candlestick is telling us that there is downward price pressure at that point, or it's telling us that sellers have won the battle. This, on the other hand, are telling us that buyers have won the battle. Now, the wicks, again, please remember these tails or wicks, whatever you want to call them, or shadows. These are like different names that people give to the tails. These are very important indicators, especially if you see it on higher time frames, on important key levels. Now, as we will go, we will understand that, candlesticks do not be traded in isolation. We need to understand, first of all, the entire market structure, be aligned with the main direction. Secondly, we need to keep in mind that for bullish markets, we should not be at the highest highs. We should be trading at a pullback or a key level. In the same manner, if we're in a bearish market, we should not be trading if the prices are at the lowest level. They should have pushed up to a previous resistance, which may not now act as a support. And it is at those places where, when you observe such price action, that everything aligns and becomes high probability, and okay, that I have a fairly good idea and I'm fairly confident that prices are going to go in this direction. And that is where you enter. So just to quickly show you some formations, which I just talked about. What is this? This is the NASDAQ. And here, so for example, I can see this candle here with a downward tail. So again, this is indicative of bullish. This candlestick again is bullish. This is bullish. And the color does not matter here. It can be green or red. The reason is that the open and the close since they are so close together, whichever comes first does not matter. Since the body is so small, the open and the close are so close together, it doesn't matter which comes first. What matters is the downward tail. Similarly, if I am to look at this particular formation here, this indicates bearish or selling pressure, after which there was the prices fell down. So I am first just going to identify the candlesticks on the chart without putting them in context, and then after I've covered these formations, I will then start to put them in context. So remember, we do not trade them in isolation. We have to look at factors such as the trend's direction, as well as the location or level of these signals before we enter. And then, of course, when we enter, we put the stop loss either on the low or the high of these candles, which are the swing points. and we do our risk management, which is the most important thing. And once we are done with our position sizing, we get into the trade. So if we are to look at more of these formations, okay, this is one formation here in gold. This is a similar formation, and what I call this candlestick a rejector. I like to call it a rejector because it shows price rejection. Now, people have so many different names for it, like hammer or shooting star or dojis or this or that, but the name doesn't matter. And there's so many different names that, it's so difficult to remember them anyways. So what you have to just understand is what it means, not what it's called. So I call such candlesticks rejectors. So this is a bullish rejector. And as you can see, if any high quality price action signal, especially a rejector, will really stand out on the chart. And what makes it high quality is not only how it's placed, it's also how long the tail or the wick is. So the longer the tail or the wick, the more strong it becomes. Okay, if you move higher up on the time frames, the stronger the signal becomes. If you move lower down, the weaker it becomes. Similarly, the longer the tail, the more the rejection. And in case of bullish rejectors, you want to really measure the rejection. It is measured from the low to the closing price. So the fluctuation from the low, again, to where it closed is the amount of rejection. The higher this price rejection, the more the bullish pressure. For a bearish candle, let's try and find a bearish rejector somewhere. Okay, I have one here on the top here. It's not very prominent, but it's here, this one. Okay. However, I would consider it to be not a bad signal because the surrounding price actions range is about the same, as this. So it's not the range of this candle is kind of equal to the surrounding price actions range. So we can consider it to be, an excellent signal, but still something that, can be taken as, relatively important to move prices downwards. So this is bearish because the tail is upwards. And again, here the rejection will be from the high to the close for bearish rejectors. The rejection, as you know, is not that much. But then again, volatility at this time period was also not that much. And the volatility has really increased over time. Again, WTI, and this was, during the height of the geopolitical tensions that we're experiencing. This was a very big and very clear rejector, and this rejector is bearish in nature. Again, this is an example of a false break of a level, which if I have time, I will go into what are false breaks. But essentially what happens is that false breaks happen when a certain important level is breached temporarily as price goes up, but then it doesn't stay there. It just comes down and it closes below that key level, which means that prices were actually not able to break up. It was a false break, right? So this is an example of a false break. So during the day, yeah, people might be thinking, okay, now prices are going up, they've reached, so the high of the day was 115, so $115 per barrel, but the prices did not stay and they closed at, so what was the closing price of this day? Yeah, it was 83. So there's a big difference here. So again, if I see, for example, let me look at the latest formation. This is WTI, which is American oil. Let me look at the latest price action. So yesterday's price action does have a downward wick. What does that mean? That means there is some bullish pressure at this level. And today's candle is again forming a downward wick, which if it completes in the same manner, it's not yet complete. So you should not ideally be looking at this last candle because this is not complete. It will be completed when the American market closes. And that's where we observe the candle. That's also a very, very important thing for you to remember. If you're working on the daily time frame, the latest candle is this candle. It's not today's candle because today's candle could completely end up looking something different by the end of the day. So you have to always wait for the market to close. Again, if there are two downward wicks in succession, that is actually much stronger than one wick. So if you have two downward wicks in succession, it means considerable upward pressure at this time. So again, if you see the way that I'm analyzing is not just a candle with a wick, but you have to keep looking at these small things, and this experience of understanding price action comes with time. One interesting thing that I should tell you that I have learned as I've been observing charts is that for wicked candles, if the wick extends into an area of the chart which is black, in this case, the background is black, so I'm saying black, if you know, so the wick is extending dramatically into the area which is black, and I see no price action on this side. So it's very prominent, right? So if I were here on this particular day, right? If I was looking at prices, I would not be having all these candles here because these formed later, right? So if I was here on this day and I was observing this candle, see that the wick is standing in isolation. It's just projecting out from the black area of the chart. So such projections are extremely powerful. They are obviously no price action is going to guarantee you 100% about a move, but then it works, I would say, over 80% of the times. And that's actually a very, very high probability, when we are talking about charts and, we are talking about just predicting prices from the price charts alone. So again, if you can see what I mean, and I can show you another example of this prominence that I think, okay, if you see, for example, and this is S&P 500, right? And I'm zooming in. So you can see this candle here. So again, this is the kind of projection that I'm talking about. There's black area and nothing else here, which means prices did not test these same levels in the recent past. So in the recent past, there was no test of these same levels, and this looks really prominent. This is a strong signal of upward price pressure in the coming days. So, and yes, there was something, yeah. And again, if I talk, this is gold. So again, gold has a similar signal, this projection in the black area. No testing since the recent few months, I would say, of all these levels. But the price tests them, rejects them, and moves up, which means considerable buying pressure has been created in this area. And if you zoom in, there's another wick. It's smaller than the first wick, but there's still a wick, which is making the whole analysis stronger. So now I have two wicks in a succession, which kind of helps me. It makes my thesis stronger that buyers are back in the market. So again, the problem with that majorly traders faces, not about understanding the structure of the market, not because it's simple. Many times, it's quite simple to say that, okay, prices here are moving up, right? This is the weekly chart for gold, right? So I think anybody can say that. It's not hard to say that this is a bullish trend. But what is hard is where to buy. And even when there is a dip, the one question that a lot of traders want answered is, okay, when is this going to end? There's a pullback, there's a dip, but when is the dip? When has that pullback ended? How do I know that this retracement has ended? And the answer to that is you have to wait for a very prominent price action to form. You have to let the prices confirm to you that the pullback has ended. You have to let the prices confirm to you that buyers are back in business. You just can't assume it without any evidence, or just by looking at some headline or some news. You just assume, okay, the pullback has ended and things look bullish again. No, you have to let the prices tell you that, yes, now they're ready to turn back again in line with the trend. So let me analyze this again with respect to gold. If I look at this formation here, okay, gold was in a very steep uptrend. This is the weekly time frame. And this candlestick here is showing a very strong upward price rejection, which means a lot of bullish pressure. And in the subsequent, and then again we had like after the next week, again we had a bullish signal. Now this particular candlestick was a false break because prices went up, but they failed to close up, and by the end of the week they had just come down, which indicated that the market on these levels, we had bears who were ready to push the prices down. And after 4 weeks, we saw this price behavior again. That, there was prices came down because they were in this particular area, there were a lot of bears who were waiting to push the prices down, right? If I look at this signal here, again, this formed when this was 23rd March week. This is that kind of a signal which I love, which I'm saying is very prominent, which has a long tail. It projects into the black area of the chart. So hence it is showing me very strong bullish pressure. This is potentially signaling an end to this dip or retracement. So if you knew how to read this, this was actually a very good point to get in as a buyer. And again, you can't always expect the prices to go up in a straight line because that doesn't happen in the markets. Yes, there can be times when trends become very fast, as in we have observed this recently in gold, but that will not always be the case. But that still doesn't matter that the market is not trending. So the trend can lose its heat or so on. And again, these clues are given to you by price actions. What is happening at the moment is overall prices are still bullish, and they could, it looks from the charts that they're still set to go up. Why? Because again, we are having the last two signals are again appearing to be bullish. We have these wicks in succession, the downward wicks, not very big, but again, significant. So again, these last two candles are signifying bullish pressure. And this candlestick is not yet complete. It will be complete when the Friday market closes, but then you can come and observe it. And if it is kind of closes on the similar levels to what we have right now, and the wick is still there, this downward wick is still there, then definitely it's signaling bullish that pressure at these levels again. So yeah, these are some of the ways that you can read, and this can help you enter the market at the right point in time. And it can also help you a lot with stop loss placements as well. So one way to put your stop loss, a conservative stop loss placement, is going to be below this swing point. That's more conservative. So I'm going to put my stop loss here and then do my position sizing, which is, of course, a risk that I've taken on the trade divided by the stop loss size. The stop loss size is given by market price minus stop loss price, right? Then if you want a less conservative stop loss placement, which will mean your position size can actually become bigger for the same dollar risk, we could put it below this swing point. So we have another swing point here. So this is a less conservative stop, more like aggressive stop loss placement, but still at a certain point of invalidation. This is yet another swing. And on the weekly, this will look like something like this. The stop loss is placed below these last two candles, okay? But then again, I am stressing the fact that please wait for Friday to see how this candle closes. It should look about the same, or maybe the prices may have moved higher up, which is even better for bullish momentum. So this is the way that we look at price action, which can fine tune our entries and, help us to, kind of make better trading decisions and to have consistent trading results. Now let's move on to another kind of a formation, which is, okay. Before we move on, I just want to tell you, okay, this is actually the same thing that I was talking about. These are also rejectors. So people have different names like Dragonfly Doji and Gravestone Doji, but basically it's the same way that you interpret them. So this downward tail means upward price pressure, and this means, so this is bullish in nature, and this means lower price pressure, and this is bearish in nature. So this candlestick would drive the prices, could drive the prices up. There is a lot more probability, and this could drive the prices down given other supporting factors. So ideally, I would try to find this in an uptrend after a pullback. Ideally, I would like to see this in a downtrend after a push up to the previous resistance, which might now act as a support, right? So I will not trade them in isolation again. I have to also see what is the structure of the market and where they are forming and the surrounding price action. Again, the same thing, bullish here because they have downward tilts, and these are all bearish. If the body is small, then we can ignore the color. If the body is big, then you might want to see how much is the rejection. In this case, the rejection is measured from the low to the close. In this case, from the high to the close. Now coming to another formation. Before that, let me discuss this. So you can have candles like these as well, which are small candles, which don't have very big ranges. And these candles are like not important in the sense that they just reflect indecision. So such a candle where you have a bit of upward spike and downward spike, and the low and the open and the close are almost the same, is reflecting indecision, or just the fact that there was no change of momentum as such, or they are just it reflects indecision and no between the buyers or the sellers. There's no decisive tone to these candles. Okay, and then again, these two patterns are what I consider to be high probability patterns, which can actually signal genuine shifts in sentiment or strong momentum or a continuation of the trend and so on, or some institutional move. The first one is called engulfing, and like it's a 2-day pattern. So on the first day, you will have a small candle form, but on the second day, you will have a much bigger candle, which is going to engulf the previous one in its range. Now, where do the prices go? If the second candle is bullish or simply green, the prices will be driven upwards because there is more buying pressure. And if the second candle is red, if it's the opposite, the first is green, the second is red, then that's a bearish engulfer. So what is the idea behind it? The idea is that, prices were indecisive or resting, and then suddenly we had this big, huge candle with a big body which swallowed the previous candle completely. And that shows a violent immediate shift in market power from one side to another. So this pattern does work a lot depending on exactly where you find it. And if I go and try to see on the chart if we can find an engulfer or show you an example. For example, this would be an engulfer here. This is again gold. So this is an engulfer. And if I'm finding so if in an uptrend, you should be looking for a bullish engulfer for an entry. And if you want to exit that trade, then a bearish engulfer might cause you to exit. If it's a downtrend, then you would be looking for a bearish engulfer for entry. A bullish engulfer will not make sense to enter. Everything is in the context of the trend, right? So in a downtrend, a bearish engulfer would cause you to enter after prices have pushed up to the previous resistance, which can now be a support. And a bullish engulfer in the downtrend could cause you to exit, because then that's a signal that the market is going to retrace or push up. So this is an engulfer again. Okay, two engulfers here. This is an engulfer. Previous day's losses are completely covered up by the next day's gains, and this is a more aggressive engulfer. Why more aggressive? Because look at the range of the candle is much bigger. The bigger the second day's candle, the more stronger this signal. And how do I classify what is big and what is not big? I have to look at the movement from the open to the close here in case of engulfers. So what the amount of movement that I can record from the open to the close is, if that is much more than the surrounding price action. So in this case, the surrounding price action was the previous candles. On this day, obviously, you will not be able to observe the future. So the surrounding price action is all this. So if you look at all these candles, look at and compare them with this one. There's a huge difference. The range of these candles is small, right? So as an example, the range of this is from, even if I look from or let me just look at the body from the open to the close. So it's 2856 and 2908. So that's about 50 points, right? As an average. But here on this day, how much is the fluctuation? From the open to the close is 3,000 to 3220, so over 200 points. So it's a big, so this is something that you have to observe. Look at the range, and there's a significant change in volatility, in market participation here. And that is something you have to understand. This is a very aggressive move compared to what was happening before. And this is what you have to read off the chart, and that's what's going to help you to kind of, okay, if you look what happened in the future, ultimately prices kept pushing up, right? Any more engulfers? So these are bullish engulfers, but in we can have bearish engulfers as well in, which can cause, okay, this is a bearish engulfer, but then again, in an uptrend, I will not be reacting to a bearish engulfer. If I find a bearish engulfer here, or what this basically means is the market has pushed back. So markets will definitely push down also in uptrends, right? Prices don't move up in a straight line, right? But this should not cause you to short. Why? This signal should not go, because we're in an uptrend, right? So we discussed this before. In an uptrend, we're looking for entries to buy. This is just going to tell you, okay, prices have retraced, and then I got another signal here, which is an inside, called an inside bar signal, which can potentially, in an uptrend, if found at such a place, it can signal an upward breakout, which happened again. So again, you always have to look at the signal in the context of the trend. Something which is bearish will cause you to just prepare for a bullish entry. It will cause you to wait, be on the sidelines, let the price drop to the level that you think is good. For example, this was my previous level, right? So I have a previous, so this forms a previous resistance, right? This part, right? Now that previous resistance became a support. This was a previous resistance, prices pushed down, and then in an uptrend, obviously, the resistance are always broken in an uptrend. And the previous resistances form support. So the same price level formed a support here. And at this point, this is the point where I want to get in. And this is the point where I'm looking for some kind of a bullish signal, right? And I do get a bullish signal, which is this and this bar, which is called an inside bar formation. So in an inside bar formation is a little bit more advanced setup, where what happens is you just have one candle and the second candle forms inside the range of the first candle. So in this type of a formation, so the colors are not significant. It's usually the location and which is significant, because such a formation represents a period of consolidation, or a period of pause, or a period of collection of momentum before the price breaks in the direction of the major trend. So this is again a kind of a setup which does require a bit more experience, but the rejectors and the engulfers are something which are much simpler to understand quickly and read from the price chart, right? So an inside bar again is not inherently bullish or bearish. So if you give me an inside bar formation, just two candles, nothing around it, I cannot say that it's inherently bullish or bearish. I need to see them in the whole context of where they are placed in the trend, right? So ideally, they can, on a pullback, they can cause the price to swing up, especially if the first bar has more than one bars inside it. So the first bar is called the mother bar, and the second you can call the inside bar or the baby. And this kind of a formation, again, is usually reflects in a strong trend, it will reflect a continuation. It just reflects a momentary consolidation, which can again break up into the continuation of the trend. So again, this is an example of a bullish engulfer, which we've just discussed, and bearish engulfer. And this is the inside bar. So again, let me repeat that the colors here don't matter. In inside bars, the colors don't matter. It's the location which matters. And they reflect consolidation, or they can cause swinging of the price at the certain point in the direction of the trend, or swinging downwards if it's a resistance, or an upward swing if it's a support. So for these, the context and the location really matters. Again, this is showing you the same thing, an inside bar. So we have first bigger bar, and then the second bar is completely within the range of the first bar. So it's within the range. Range means from the high to the low. So let me just go back again and try and show you some inside bar formation and how it works. So I think I observe one in S&P daily. S&P daily time frame, yes. So this is so we have a strong upward momentum, right? And this is an inside bar formation. So this is the mother and these are the babies. So this is reflecting consolidation. And in the context of a strong uptrend, a consolidation will usually break upwards. Okay. In the context of a strong downtrend, if you see such a consolidation or an inside bar formation, that will usually break downwards. So what happened was we had this mother candle, and then we had these babies inside the mother. So we had 1, 2, 3, almost 4 babies, right? So having more inside bars or babies is better because that represents a price coiling. And then sometimes you actually can have a much more explosive move up when the consolidation breaks. Somebody might think, why didn't the price break downwards? It didn't, because the overall momentum or strength was upwards. So in such a case, the inside bar will usually break upwards. So if I zoom this in, also notice one thing. I have these little downward tails. I have a tail here. So the downward tail reflects upward pressure. So within that, I can also look at the price action. See, I have some downward rejection here as well. I have a consolidation here as well. So I can wait for the consolidation to break upwards. Where is the stop loss placement? Again, below the mother candle. So below the low of the mother candle would be a good stop loss placement. And if you want to be more conservative, you can even put it below the previous candle if that candle is small. So if I feel more, I want to be more conservative about my stop loss. Yeah, but then this stop loss can actually work because this formation is a 5-day formation. So it's a pretty strong formation. It's not it's a 5-day. Yeah, so this can work. And then how do you do a risk management? Please remember you have to take your position size is equal to your risk on the trade, which can be anything. It can be close to 2% of your account's value or whatever you have decided, divided by stop loss size, right? And the stop loss size, as you know, is given by entry price minus stop loss price. So this is going to give you the quantity, how much you should be trading for you to fix your risk at your chosen risk level. So if in any case you get stopped out, you lose exactly what you have planned. And that's extremely important. It's very, very important. So yes, so we just have 3 minutes left now. So just to conclude this session, I would just like to say that, when you are looking at these signals, please remember that you have to definitely look at not just the candle or in isolation. You have to look at the market structure, the key level. Trading with all these factors is going to make your trading high probability. A candle pattern by itself has limited value unless you align it with the overall market structure and environment. That environment begins with a clear understanding of, first of all, the bigger trend, which we can observe on the weekly and the dailies. And also, many times you will find that there are certain markets which are not trending nicely, which are choppy. And the best way to deal with those markets is to leave them alone and not take any position unless those markets become easier for you to understand. After that, what you do is you look at the key support and resistance levels where you think that which can be major turning points. It is at those areas where you then look for specific candlestick signals. And that is where they actually become meaningful. So when you're combining structure, location, and behavior, price action behavior together, then the probability of a trade improves significantly. And once you have identified that setup, then of course you should not forget the risk management. And equally important is the time frame. Higher time frames carry more weight because they reflect a broader market consensus. And the New York session close in particular is a very critical closing point. You can read that off the daily time frame. That is gives a very reliable picture of the day's sentiment. And price action form there tends to be more stable, more predictable than smaller time frames. So it's about having as many factors as possible in your favor when you start the trade. So you have to align all of these factors. And yes, it can take time. You were not going to find uh, all these factors aligned in your favor daily. It might not happen daily. The trade might come after a week. It might come after 2 weeks or 3 weeks. But remember that trading, if you have to take trading seriously, then you know that you are committing your capital to a certain trade. You are investing your capital in a certain trade. There have to be proper reasons why you're investing. Just like you're investing capital in business, obviously you have done your due diligence, and you have so many reasons why you invest in a business. Similarly, every trade is like a small business, and you need good reasons to open the trade. So if you have to remain disciplined and wait for these multiple and elements to confirm the same idea, and that patience and selectivity is what is going to separate you from any random market participant. So the time is over, and I hope that you enjoyed the session. So I couldn't find time for discussing false breaks, but I will definitely keep that for another session. So I have another webinar coming up on Tuesday, which is about introduction to the major indices like S&P, Dow Jones, NASDAQ, and what drives them and how to trade them. And on Thursday, we will do these key indices, and we'll focus on wallet like trading opportunities between them and how they're different from each other. So thank you so much for attending today's session, and good night.